It's Thursday, 3rd of October, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and am once again joined by Group Chief Economist Neil Shearing. I'm also happy to say we have a special guest this week. Larry Adam is Chief Investment Officer at Raymond James and is on the line from Baltimore. Hi, Neil, and hi, Larry. Welcome to the Weekly Briefing.
Hi, David. Thanks for having me.
Hi, David. So there's a lot of ground to cover. I'm eager to hear thoughts from both of you on global macro, find out where Raymond James views align with capital economics, and perhaps explore some areas of difference in all of that. But to start, for listeners, Larry, tell us a bit about your role at Raymond James.
So I am the Chief Investment Officer here at Raymond James, and my main role is really to provide what we call the CIO view. And basically what that means is that I have a group of analysts and economists, and we look and take both internal and external resources to really construct what we call the CIO view. And as you guys know, that's really important because sometimes when you're on the more institutional side, every analyst loves their asset class, right? Well, we have to make sure that things kind of fit together in a portfolio perspective. And then the one point I always like to tell people, and similar to your team, is that I think it's a skill, but one of our best attributes is that we're able to put things into a very understandable fashion, right? We go with the saying that if a tree falls in the woods and nobody hears it, did it make a sound? Well, we say that if the CIO makes a call and you can't understand it, remember it, or invest in it, did I even say anything? So we try and put it in very understandable terminology and words.
We are big on coherence and concision at Capital Economics, but you mentioned their external resources. By way of follow-up, and as a Capital Economics subscriber, can you talk a bit about how independent analysis like ours helps your work with your clients?
Absolutely. So obviously we are loyal subscribers to Capital Economics. And as I mentioned, Capital Economics is part of our mosaic that we use to construct our views. And in particular for us, when it comes to the international markets and affairs, we tend to incorporate your insights from the vast network of contacts and analysts that you guys have throughout the world. And as you mentioned earlier, when we were talking about even before this call, given everything that's going on in this world, from Ukraine, Russia, Israel, elections around the world, I don't have a team big enough to cover all that. So we do rely on your insights, and for the most part, they're very invaluable to our construction of our view.
Okay, well, there's more than enough to chew on there, but let's get straight to it because we are recording this a day before the September U.S. employment report released. Larry, what's your view of the U.S. economy at the moment? What kind of landing do you think is on the cards here? Is it a soft one? Is it a hard one? Is it none at all?
We're in the camp that we are going to see a soft landing. And if you look at our economic forecast, we think that GDP this year is going to be 2.6%. Next year, we're going to grow at about 2%. What's going to continue to drive growth next year to help us avert a recession are really three primary things. First of all, I think the consumer is going to be resilient. And the reason we think of that is because I don't think job growth is going to turn negative. It's probably going to slow, closer to 100,000 jobs being created, but it's not going to turn negative. Second, I think you're going to continue to see government spending be very supportive of the economy. And what we like to tell people is that when you look at all of those policies that have been passed, whether it's been the CHIPS Act, the Inflation Reduction Act, the American Recovery Act, when you take all that money, only 20% of that has actually been spent. So that leaves 80% still available to be spent over the next couple of years. And I think that'll help support the economy. And then third, we do believe that the AI theme is for real. We're still in the early stages. And when we talk to businesses, that continues to be a focus of where they're going to spend their dollars next year. So I think that will continue to help from a spending perspective. The one point I do want to make is that as we get closer to that 2% level, I always like to make the analogy of driving a car. And if you think about it, the best fuel efficiency occurs when you drive between 35 and 60 miles an hour. And that's because you balance aerodynamics with engine efficiency. If you go too fast, all of a sudden your fuel mileage goes down. And if you're starting and stopping, obviously you don't get good fuel mileage. So when you're in around that 2%, which is essentially pretty close to what potential GDP is, that'll help elongate this recovery and expansion for the foreseeable future.
Neil, a lot of what Larry's just saying there, I mean, that echoes our forecast, doesn't it, to a great extent. But take that a bit further. Talk about what our US scenarios dashboard is saying. Give us the latest signaling from that.
Yes, I think we're in the soft landing camp, as we've discussed on this podcast before. In fact, we're talking on Thursday. We've just had the ISM Services Index released for the US. I mean, that's painting the picture of almost a no landing, a renewed pickup in services activity and really underlining the apparent resilience of the US consumer. So yes, I think soft landing, we've called it a Goldilocks scenario. That's the most likely outcome in our view, and that's the one that we ascribe the highest probability to in our scenarios dashboard. Interestingly, what happened at the start of this year was we essentially have 4 scenarios: hard landing, soft landing, stagflation, and no landing. The probability of a no landing scenario, where the economy keeps growing at kind of 2-3% and inflation remains high, that actually picked up at the start of this year when we looked at the incoming data. It's now dropped back, and soft landing as a scenario has picked up in terms of probability. If we get much in the way of data like today's ISM services repeated, then I suspect the no landing probability goes up again. And some of the more aggressive rate cuts that are priced into the markets, I suspect will come out. Of course, our view on that is that rates will be cut, and we've been dovish for a while, but the market's probably got slightly ahead of itself in terms of anticipating monetary easing by the Fed.
Right. I mean, Larry, where do you stand on that? We've had Jerome Powell signaling there's no real hurry on the Fed's part to cut rates. I mean, do you see, with all that you've just said about the strength of the US economy, do you see any parts of it which argue for a more urgent approach to rate cuts, or is gradualism, the kind of gradualism that we're expecting, the right approach overall?
Yeah, I would probably agree with the gradualism. We're looking for 2 more rate cuts this year, 4 more next year. I think the difference that's really important to accentuate is the fact that the Fed is cutting this time around because they have the ability to be very proactive to cut rates, and they're not being forced to do it. And what I mean by that is if you look at the last 3 times the Fed has been cutting rates, they've been forced to do it, right? It's been COVID. It was the great financial crisis. It was when we had the tech bubble bursting and a recession after 9/11. But this time around, they can actually take their time. And a lot of this, to me, is really more of an insurance cut to make sure that they can elongate this expansion. The other thing that's really important to me when I talk to clients is I'm not overly concerned whether next year is 4 cuts, 8 cuts, 2 cuts. I think the more important thing is what's the ultimate result? Is it a soft landing, or is it going to be a hard landing? Because from an asset class perspective, that's 2 totally different environments that can dictate what the performance is going to be. And we are on the side that the Fed's going to do enough to, again, engineer that soft landing.
Yeah, I think that's a really important point, isn't it? That particularly when you look at the equity market, the difference in equity market performance through tightening cycles and then loosening cycles where the US economy has avoided a recession compared to those where the Fed's tightened, pushed the economy into recession and then subsequently loosened. I mean, it's night and day in terms of the stock market performance. So the fact that we're both suggesting that soft landing, the most likely outcome, I think is supportive of the equity market. I think the other point I'd perhaps add to all of that is that when we think about the magnitude of rate cuts, and this is a conversation we have constantly with clients, how many rate cuts they're likely to be, the framework that central banks have and economists have for thinking about this is through the prism of neutral interest rates, right? We think about what's the level of neutral interest rates that are consistent with the economy being at full employment and inflation being at target, so-called R star. And I think we can construct a reasonable argument to suggest that R star is a bit higher now. Indeed, we have done so. But although the concept of R star is easy to articulate, it's really difficult to pin down in practice. So central banks are slightly flying blind on this one. They don't quite know what the neutral rate of interest is, I don't think. And so, yeah, when we piece that together, I suspect R star is probably somewhere around 1% in the US at the moment. Add on a 2% CPI number or PCE number, that gets you to 3% nominal. So I suspect that's a reasonable approximation of where rates will be heading over the kind of medium term.
So higher than perhaps we've been used to. Neil, you just mentioned the stock market. Larry, you spoke about asset price responses to easing. Let's get on to your view on US stocks. I think it does chime with ours in that you see this AI story as a driver of US outperformance ahead. In fact, our markets team has just put out a note explaining why they think US equities will take the lead again soon. But talk about, would you, the Raymond James view of the relative performance of the US stock market?
So versus international markets?
Yeah.
I do think that the equity markets here in the United States will continue to, outperform. I just think the dynamics are set up just fundamentally and then thematically. First of all, from a thematic perspective, as you mentioned, we still like technology. And when you invest in, for example, the United States, you're getting over 40% of your exposure is in tech-related sectors. When you look at Europe, it's far, far less. In fact, when you look at the names, right, they kind of roll off your tongue when you think about the U.S. When you go to Europe, there's not quite the name recognition that because it's a lot less. So thematically, investing in the U.S., you're going to get more technology and healthcare, and those are two of our favorite sectors. I think fundamentally, if you look over time, you continue to see that the U.S. far outpaces what you get over in other countries of the world when it comes to, for example, top-line revenue growth. The economy in the U.S. continues to be far more resilient than what you see around the world. I'll just give you one quick example. This year, right, if you look at the biggest economy in Europe, Germany, when we came into this year, consensus was that the economy was going to grow about 1.5%. Well, as of this week, consensus is at 0.1%. The German government says it's going to be flat. If you look at the U.S., consensus coming into this year was that GDP growth was going to be 1.5%, and now we're up to 2.5%. So that just gives you a little bit of the flavor, the vitality of the underlying fundamentals of the economy. And then when you look across the board at all the fundamentals, you look at top-line sales growth. If you look at profitability, U.S. corporations continue to be the most profitable and efficient companies around the world, and their margins are much bigger than what you see in most places. So that helps drive earnings growth, which continues to be far superior in the U.S. If you look back over the last 10 years, a lot of people will say, well, the U.S. has outperformed. Europe, for example, is likely to catch up. Well, that's been fundamentally based because if you look at earnings growth just over the last 10 years, it's exceeded 100% here in the U.S., whereas in Europe, it's been right around 50%. So fundamentally, that outperformance has been warranted in the U.S., and I think that that's likely to continue. And then when I look at shareholder type of activities, meaning increases in dividends or buybacks, they're far more superior here in the U.S. So while valuations may be a little bit more expensive in the U.S., I think that they are warranted, and that's why we continue to favor the U.S. over other international developed markets in particular.
Yeah, I think one of the points that we've been debating internally and indeed discussing with clients is the extent to which what we're witnessing is a bubble in AI stocks. When we look at the history of revolutionary technologies, general purpose technologies that transform productivity growth, what tends to happen is it takes a while for the productivity benefits of that technology to come to bear in the real economy, but markets try to crystallize the benefits ahead of them actually coming to fruition. So it tends to be fertile ground for bubbles. That was certainly the case in the dot-com boom. And our sense is that history may be repeating itself. So, I mean, actually, we're even more bullish on US stocks than you are, Larry, over the next 12 months or so, because we suspect that there's a bit more air to inflate into what appears to be a bubble that's starting to form. Valuations, you're right, they're certainly more stretched in the US, but then that kind of goes with the territory if it is a bubble. The question to our mind is, for how long can this continue to inflate? And we got a bit of a wobble, didn't we, over the summer? But that gets us back to the key point that we were discussing at the start, which is we got that wobble because there were some concerns about not just the stretched nature of the stock market, but because of the direction of the real economy. And since then, the data have put some of those concerns to bed, or at least pushed those onto the back burner, and the stock market's resumed its upward trajectory. And I suspect that's the course we're set on for 2025. And I know you've got an end-year target, Larry, of 5850 on the S&P. Actually, we think it could get closer to, well, certainly beyond 6,000, perhaps closer to 7,000 next year because of this bubble. What happens after that, I think, is up for debate. But I suspect the next 12 months will be a good one for US stocks.
Yeah, the one comment I did want to make about tech companies, because a lot of questions do come about the parallels to 2000. I think it's important to just recognize that these companies are far different than they were back in 2000. Yeah. Back in 2000, most of these companies were one-trick ponies, right? They were either software or hardware, and they kind of rode the ups and downs of the upgrade cycle.
Yeah.
Well, they're not necessarily like that anymore. right?
And they're really
They're much
profitable.
more
These companies are actually making profits, as you suggest. Their earnings are strong. These are not scrappy startups that are loss making for decades. These are generating genuine earnings. So yeah, I completely agree. It's very different context.
Pets.com RAP. I wanted to stay on this question of US outperformance in AI because I was struck. We had a client briefing here in London recently, Larry, and there was someone in the audience who was shocked really to see that China ranks just 18th in our AI economic impact index, which is this ranking that we have of major economies by their ability to develop, diffuse, and adapt to this technology. The US at number one, obviously. Neil, with all that Larry said about the strength of the US economy, US markets, it might be worth reminding us why China fares so poorly in this index, but also what it says about the economy's outlook.
Yes, indeed. I'll come back to the economy's outlook because I think this ties into it. But essentially, when we put that index together, there were three pillars. There's the development pillar of technology. So what's the ability of the economy to actually generate the technology in the first place, develop the technology in the first place? There's the adoption pillar. So having developed it, how easy is it for companies and firms within the economy to adopt the technology? And then in particular, the really important one is the adaptation pillar. So you're going to push through an enormously disruptive technology through the economy. You better be sure that you've got flexible labor and product markets to deal with that because it's going to create quite a lot of disruption. And China is really, really at the technological frontier in terms of developing some of this technology. But when it comes to adopting the technology, diffusing it and adapting to it, the economy is much less well-placed, certainly compared to the US. And really that speaks to, I think, as you kind of hint at, that the broader economic outlook. China's economy at the moment is a bit of a Jekyll and Hyde economy. On the one hand, here in the West, we're concerned about China's dominance of green technology, of electric vehicles, of batteries, and its rapid development in areas like semiconductors. So where it's really pushing the technological frontier. On the other hand, we've just seen what appears to be quite a big package of stimulus measures, both fiscal and monetary. Some of the meat needs to be put on the bones of that package. But the fact that the authorities are loosening both monetary and fiscal policy suggests there's clearly a concern about the cyclical outlook, about the weakness of the economy. So it's a bit of a Jekyll and Hyde economy, China's economy. On the one hand, pushing at the forefront of technology, but on the other hand, going through a soft patch. And I suspect what we're going to see over the next 12 months is bit of a cyclical pickup as some of the monetary and fiscal stimulus starts to work through. I don't think it will be quite as impressive as some of the bulls are expecting or anticipating, or perhaps not justifying that big rebound that we've seen in Chinese stocks over the past week or so. But these really deep-seated structural issues in China, particularly around the property sector, a legacy of overinvestment, a legacy of centralization when the market needs to do more work, they're going to continue to bite. And I think eventually the cyclical recovery will, at some point next year, meet the reality of those structural challenges.
Larry, what's your take? I mean, what's your view on the news flow from China? And I mean, as an asset allocator, how are you looking at what's happening with Chinese shares with the Hong Kong market?
Sure. I think, as Neil said, I think what happened with China's stimulus package, they became the latest contributor to the global easing that's taken place, right? I mean, I think it's important to put in context that not only is China easing, but you have central banks around the world, whether it's the ECB, Bank of England, Swiss Bank, Bank of Canada, the Fed, right? Everybody's been cutting interest rates because they are seeing some signs of a slowing economy. Some places in their rounds slowing more than others. But I think that that's just part of the whole world, for the most part, trying to ease some of these financial conditions. I think the recent stimulus, as Neil mentioned, was particularly aimed at stabilizing asset prices in financial markets, particularly the equity market and the real estate market. But our strategist, similar to Neil, believes that you'd have to, for a more meaningful impact, you'd probably have to see more direct stimulus, putting actual money into the hands of the consumers to really get that economy to get more momentum in spending, particularly for the middle class. Now, as you mentioned, the impact on the Chinese equity market, it's been incredible, right? I mean, how many times in just 2 or 3 weeks do you see an index hit its 52-week low and its 52-week high? I mean, that's pretty impressive, right? Because it rallied almost 30%. And part of that is because I think a lot of asset allocators around the world were caught flat-footed. Most people were underweight China and it forced them to re-up and narrow that underweight when it comes to their positioning there. I also think that when you look around the world, you saw some periphery assets participating, right? In the U.S., for example, companies that had a lot of exposure to China, they outperformed last week. If you look at some of the luxury goods producers coming from Europe, they outperformed last week. But if you look so far this week, they've started on a relative basis actually start to underperform, because I think there is some skepticism of whether or not this really is the juggernaut that it's going to be. And I still think that there's still some questions about whether or not that will happen. I think one thing that our strategists will be watching is what is some of the data that comes from the holiday period. You know, they're celebrating the China Golden Week, right? So everybody's moving around, celebrating. So when we start to get some of the data from the consumer there, it'll be interesting to see if there really was any type of uptick from some of the more positive sentiment that potentially flowed there.
Yeah, it does feel like we're in a bit of an information vacuum now with this week-long public holiday as well. So presumably we'll start hearing more when China gets back to business. I'm conscious of time. I wanted to finally get views from the two of you on these two key risks that are facing investors at the moment. First, news flow from the Middle East has been distressing. It does feel like every new development brings Israel and Iran closer to direct conflict, really. It's a geopolitical story, but it's got market implications. How are investors meant to play it? Larry, what's your take on what's going on?
So, as you said, it's a very sad situation, and I don't want to underestimate that it has been, as you mentioned, very sad. From a market's perspective, though, I think it's important to recognize that from a corporate earnings or revenue perspective, we're pretty much insulated from that part of the world. You know, if you look at Palestine, Israel, and even Lebanon, U.S. corporations, the S&P 500 gets less than 0.5% of its revenues from that particular area of the world. So for the most part, from that lens, we're pretty much insulated. So then the biggest impact that could potentially arise is what happens to the price of oil. And as we get pretty close to anniversarying the 1 year since this incident really started to unfold between Israel and Hamas, the price of oil is still slightly below where it was 1 year ago. You know, when the event started, it was at 74. Today, it's right around 72. So we really haven't had that big impact that everybody was worried about. And as you mentioned, that's because while it has heated up, there have been many time periods where you've had this de-escalatory type of environment. But if, in fact, you were to see something become more meaningful where Iran and Israel were to become in direct, ongoing, consistent conflict, that could potentially have a bigger impact on the markets longer term. The other point that I would make is why I think that there's been less impact overall is the fact that U.S. oil producers, I mean, we're producing, not only are we the largest producer, we continue to go to all-time record highs in the amount of oil production that we are doing. And that kind of tamps down some of that impact from what's going on in the Middle East.
Yeah, I think that's the central point for me, Larry. I think that's a really good point. Is that it continues, in my mind, to be the biggest story in global markets and the global economy that no one's really talking about. The enormous shift in the US from being a large energy importer in the early 2000s, the world's largest, to a net energy exporter. It's changed the US economy, the face of the US economy, and its balance of payments absolutely manifestly. I think the other point that I would add to that, I mean, I agree with everything you said. The other point I would add is that it's not just the US, but Saudi is also sitting on large amounts of untapped capacity as well. So currently producing about 8 million barrels a day, could produce 12 million barrels a day. I suspect that if we were to get a strike on Iranian oil facilities by Israel, you know, Iran produces about 4% of global oil. To put that into context, you know, the Saudi could open the taps and compensate for some of that loss, surely. So I think it's the responsiveness to supply is the key point here, both in the US but also elsewhere in parts of OPEC, particularly Saudi. And I think that's why we've not really seen a big move in the oil price. I mean, I was looking this morning. Oil ended August at $80 a barrel, and it's now 76. So that tells you everything you kind of need to know about how the market's really feeling.
I can't let either of you go without talking about the US election. Obviously, lots of attention on the outcome, but in the grand arc of macro and markets, how much influence do you think a Harris or Trump victory is really going to have? In terms of November, which would be the better candidate for investors, do you think? Larry, do you want to have a go?
Sure. So I think the biggest thing that's going to happen here is that I think you're going to see an uptick in volatility. Just to give you some of our findings is that when you have an open election, which this is, from this point to election day, the equity market tends to be down about 1.5%. In fact, it's been down the last 6 elections. We've been down from this day to election day. Now, the good news is that once you get through the election and we actually know who is going to be the president and what the composition of Washington is going to be, the market does tend to recoup its losses, and then it does go higher from there. When it comes to who is the best for the market, we got to see what happens after the elections, because I will tell you, one of my biggest battles is that I'm going to hear strategists and coming out on the street saying that you got to be in this sector or that sector, when if you look back, it really hasn't worked out that well. And I'll just give you 2 quick examples. When Donald Trump was elected, right, in 2016, what sector did everybody tell you had to be in? It was energy, right? Drill, baby, drill. And during his 4 years, it was by far and away the worst performing sector. It was the only sector that was negative during his 4 years in office. What sector did everybody tell you to avoid when he got elected? It was technology, because he was going to go after Silicon Valley, the CEOs and tech companies. Well, if you would have listened to that, you would have missed out on the best performing sector by a long shot over that 4-year period. Fast forward to President Biden, the sector everybody told you to avoid was energy. Why? Because we were going to have the Green New Deal, renewable energy sources, ESG concerns. Energy, to many people's surprise, is by far and away the best performing sector under President Biden, outperforming even the technology sector. And what sector did everybody tell you had to be in? It was consumer discretionary, because of universal income, the fact that we were going to have all this stimulus and people were going to have more money to spend. It's the worst performing sector during those 4 years. My point is that while we do include politics in our 10-factor dynamics that we use to assess where the equity market is going to go, it ranks number 8 in importance. It's far more important to know what the economy is going to do, earnings growth, what the Fed's going to do, sentiment, valuations. Those are far more important indicators to know than who's sitting in the White House and in Congress.
I think it's a really good point, well made, that there's this tendency to overstate the effect of elections on markets. I don't know if we can't really say the same for the global economy, can we? Neil, I know you've been looking very closely at the breakdown of US-China relations, and you've shown that there does seem to be a fairly clear-cut outcome in terms of what we could expect from a Harris administration or another Trump presidency. Talk a bit about that difference, could you?
Yes, certainly. I mean, I think part of it comes down to one of time horizons. Are we talking about the outlook for first half of 2025 in terms of the US election affecting the global economy? I mean, I don't think it's going to make much difference, to be perfectly honest, if that's the time frame we're thinking about. Rather, the point we're making is a bit more of a subtle and nuanced one about the long-term structure of the global economy. And in our view, there's one of the big debates is about whether the world is still globalizing or whether it's deglobalizing. We've set out a view that we think the world, rather than deglobalizing, actually is fracturing. It's pulling into these 2 blocks, one that's coalesced around the US and one that's coalescing around China. And if you view the world through that lens, then the US's great strength, America's great strength, is alliances around the world. Within its block, it has Europe, kind of mixture of high-end, advanced manufacturing economies and service-based economies. It's got Japan and Korea and Taiwan, again, high-end technology companies. Vietnam, Mexico, low-income manufacturers. India, low-income service-based economies. So it's got both the world's largest economies, but also a huge amount of economic diversity within its block. So if it wants to start to move production of something out of China because of national security concerns, then it can, there's plenty of alternatives within its block. China, on the other hand, its allies are both smaller in terms of their economic heft, their GDP, but also they're pretty similar. They're commodity producers or they're autocracies of one form or another. So if you get an election result that results in a second Trump administration, and that second Trump administration pushes a more isolationist approach, then what that does, I think, is chip away at America's advantage in this fracturing world. It starts to fray some of those alliances. Now, that's not going to affect the growth outlook for 2025 or 2026, and it's not going to meaningfully affect asset returns over that period either, I don't suspect. But if it's sustained and you play it through the course of this decade, then I think it can start to have a meaningful effect on how this fractured world starts to affect the impact upon the US economy, and not in a positive way. I mean, in that sense, America first would mean really America last. It would undermine its core advantage in this fractured world.
I guess if there's one thing, I do think that in Washington, there is clearly, if there's one unifying topic, it is China, right? Both sides, both Democrats and Republicans want to go against, protecting our national interests when it comes to China. So I think that regardless of who wins, I do believe that is going to be a consistent theme down in Washington. I do think, it's interesting. I was on a call the other day that both sides are increasingly getting competitive. I think there's a BRIC meeting coming up, right, where they're going to talk about a petro yuan to start pricing oil, right? So there are attempts. I don't know if they will be successful, but there are attempts, like you said, to try and break away a little bit more from the U.S. that I think we do have to keep an eye on going forward.
Neil, I thought you'd take the bait with the mention of the petro yuan.
Yeah, do you know what? I nearly started. It's one of my bugbears, this, Larry. So the idea that the renminbi is somehow going to be transformed into this internationalized currency that will rival the dollar. If you look at the trade flows between China and the Gulf, they're not big enough to really seriously threaten the dollar. It's about 5% of global trade, something like that. And China doesn't have an open capital account. Its institutions, there are question marks over. It runs a current account surplus, so it's not supplying renminbi to the rest of the world in the way that you would need to if you were going to try and internationalize your currency. So, I mean, look, all our forecasts are subject to enormous amounts of uncertainty. That's the caveat we always give it, isn't it? I'm willing to take a punt that wind the clock forward to the end of this decade, the US is still by far and away the world's most dominant currency.
And we would agree with that 100%. And the other thing that would add to the challenges of any type of currency rivaling the US when it comes particularly with oil is just look at the derivatives market that is already dollars. Right? That would be a humongous nightmare trying to convert those things over time as well. So I agree with you completely. The US dollar is the dominant currency in the world. I do not believe it will lose its vitality, but I was just saying that there will be these little attempts over time to try and gather enough momentum, but I don't think they'll be successful.
Yeah, I agree.
Yeah, it's a story that keeps financial journalists busy. I'm afraid, though, that is all we've got time for. Neil, thanks as always for coming on. Larry, thanks for joining us. Your latest quarterly letter is out. I think it frames the outlook for the global economy, for markets, as a sort of great American road trip. I thought it was a really interesting read and a fun read as well, actually. And I will link to it in the podcast notes. I was thinking about a British version of the great American road trip tradition. I could only come up with trying to light a barbecue in the rain on a campsite in the New Forest.
Well, yeah, that's a nice idea for the UK economy as well.
It's an idea for your next Sunday note. Thank you both for joining me. Thanks out there for listening. We'll be back next week with more from the front lines of global macro markets, including a preview of the ECB's October meeting. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.